Hello, good morning. Welcome to the SDS weekly webinars. And this is a big one. It's the Shared Ownership Program update. Andrew, good morning. How are you?
Good morning, Christopher, and good morning, everyone. I'm very well, thank you. I'm looking forward to hearing some people's views on the update of the shared ownership.
Yeah, so clearly it's had a popular outcome in terms of registrations and attendance. What is it you're hoping to achieve from the day?
A little bit of detail, if there is. I know, obviously, speaking to the colleagues, that we're still waiting for some information, but it'd be interesting to hear people's views. Are they excited about this new model? Are they got their heads around it now? Are they been modelling it on viability? Are there any questions on that? What the impact that will be on Proval? You know, I'm here to ask those questions, and SDS is really, you know, looking at kind of ways of supporting our clients and seeing if there's anything we can put into the system going forward that would help them model that clearer. But we're here to discuss, hear some questions and put those to the panel, and I'm here to facilitate that as best I can.
Thanks a lot, Andrew. So I think it's only right that we bring on our resident specialist, Greg Warner-Harris. Greg, hello, good morning.
Good morning, Christopher. Can you hear me? Can you see me?
Absolutely, we can. So obviously a lot going on, Greg, and we're all very interested in understanding your reaction to what we now know.
Yeah, well, you know, I've got plenty of thoughts around this. I can give an overview where we are. I think what we can say is we've got three conversations that have been brought into one. The new model of the shared ownership lease, and you know, I can't believe this has been running for 2 years now. This kicked off in 2019. The discussion paper went out in the August, and it was formally announced in the Queen's speech later that year. So that's, I think, what everyone's trying to focus in on now. We've got some detail coming out of following the technical conversation. But let's not forget, we've got the right to shared ownership coming into the conversation as well, and that's been tied into this new model as well. And of course, this year, Robert Jennick announced the leasehold reform, which we knew about as well, and that's the big long lease, 990-year lease, which has been brought into conversation as well. So a lot there. I've got perhaps three major things on the new model to kick off with and to get things rolling.
Excellent, excellent. And so everyone listening right now, please do ask us questions. This is meant to be an engaging discussion. So as they come to us, as they come to you, please do let us know and we'll bring them in.
Do we know how to do that, Christopher? Because I don't.
Yeah, so there's a questions tab in GoToWebinar. And if you'd like to basically just, if you can all have a look there, it should be in your control panel. And if you'd like to pop in the questions, I'm monitoring all of them. So obviously we've got a couple here.
Under chat, is that? Yeah.
Yeah, well, chat is actually, yeah. So there's two here. There's questions which come straight to me, and then there is chat.
Oh, okay. Cool.
Okay, excellent. Okay, so Greg, any more to say?
Just that, you know, I think, long story short, although it's 2 years ago when this kicked off, I don't think things have changed much from what we expected from that initial discussion paper. There's a lot of nuances that have been sort of filled in, still some gaps, and I'm looking forward to Jonathan sort of filling in some of the legal aspects of those for us. Of course, how we deploy this needs to be looked firmed up, and we're waiting on the revised capital funding guide for that and lease. I had an email from Homes England about 2 weeks ago. They are committed to get that out by the end of May, but it was previously end of April. We'll see, but they need to get rolling on it. The interesting thing, of course, is strategic partners have had to bid slightly blind on this, but those of us who are engaging on the CME, we're looking forward to seeing the final detail from the capital funding guide. But as of last night, it was still showing watch this space.
Okay. So we have Jonathan, who basically his name is, yep, I've got him here, Jonathan Corris from Devonshire's. So Jonathan has prepared some remarks Jonathan, if you'd like to join us. And we're going to go through his presentation. He's going to basically make some notes here on what sort of things we need to be looking out for. Hello, Jonathan, welcome.
Hi, how you doing?
Jonathan,
Thank you very
would
much.
you like to just introduce yourself as I am bringing your PowerPoint up?
Yep, thanks. My name is John Corris, partner at Devonshire Solicitors. In our real estate team, I handle quite a lot of matters in relation to the affordable RP world, in particular in relation to the shared ownership services that we offer, also advising clients on strategic elements involving shared ownership bids and also delivery of different housing products. So that was a brief synopsis of what I pick up. But yeah, so I've been asked to talk today and provide a few slides. I'm just going to follow on from some of the comments that Greg's already kindly made. And then Greg, please, if there's any point where I'm saying something you want to jump in, then please feel free. I think the format allows that, doesn't it, Christopher?
Absolutely, absolutely. We
Yeah.
want this to be talkative, engaging. Like I said, just let's keep talking.
Brilliant stuff. So I'm just going to pick up from reinforce Greg's comment in relation to where is the lease and also the capital funding guide and a few other documents we've been waiting on for a while. The last room I had is it's back with MHCLG for comment. There may have been a few bits that have been moving around in relation to the documents, and some other questions that I think everyone's had have come up from the relevant consultations and the stages that have been going on, particularly building up speed in the last 6 months. I think, Greg, was it end of the month you'd heard as well, was it?
Yeah, the email, I got a bunch of stuff delivered to me last week, sorry, the week before that, and in that there was a commitment for the lease to be available by the end of May, along with the updated capital funding guide.
Yeah. Okay. So fingers crossed, we'll see something more then. I've got to be honest, I don't envy the task of having to draft the lease, given some of these things, in particularly in relation to how you deal with repairs and stuff, but we'll come on to that in a moment. So yeah, on the slides, just sort of going through the points, and forgive me if this is stuff that everyone is all fully aware of. I'm sure they are, because it's been inside housing headlines and other various means. First tranche, 10%. So yeah, the big change, the first tranche, the right for basically everyone to be able to buy their home following from government policies, which are well documented. There's going to be an introduction for a 10% level for an intro stake. That all sounds quite interesting. There's a number of conversations that I know clients have been having, RPs, in relation to what does that mean in relation to how they model a scheme, the value of the shared ownership, as they're only getting a 10% receipt on day one. And I know a number of appraisal models have had to be varied on the basis of what this could look like going forward in relation to how much they could pay for a site, development and land values, etc. So there is a knock-on effect. One of the other things is who's actually funding that 10%. I know there's shared ownership has often had the phrase the bank or mum and dad coming on board and helping people being able to fund their 10% tranche, the 20% tranche originally in 25 and 30. Is this going to be even more prevalent on the 10%? There have been a few new lender names popping up, offering people the ability to be able to fund the 10%. There's a question as to what actually are those lending terms, and are we heading more towards credit card market or staying towards the traditional mortgage market, and whether those terms are actually in the favour of tenants. So I've got to be honest, I don't know, Greg, if you've seen any more on that, but there's a lot of talking about it. I haven't seen much of the products yet. Yep,
okay, let me chip in on that one. And I guess there's two sides to the coin. There's the funding for the purchasers and the funding for the providers. On the purchasers and mortgages, I just need to refer to some notes here, because I was talking with a broker, a specialist shared ownership mortgage broker that I work with a lot. And what they did, they pinged out an email to, I think, 6 of their big name shared ownership providers, and just to see where, what's come back. Now, I need to stress, this is at underwriter level. Okay, because they work with these guys on a day-to-day basis. They know them by first name terms. It's not what's discussions being had in the boardroom. So it's slightly sort of gossip, slightly anecdotal, but it's useful information. And out of those, one of them said, so 3 of them said they'll be sticking with 25%, as far as they knew. But this is underwriters, I should stress. One has come back and said they'll be sticking with their minimum loan of 25,000. So 10% is possible in higher value areas. Another one came back and said they will be sticking with their minimum 50,000, and some of us will be able to work out who that is, but I will mention no names. So 10% is only going to work in very high areas on that one. Sorry for my mobile phone, I've killed it. And one of them said the underwriters were aware of the discussions and they were considering their positions. So at underwriter level, it's still sort of an unknown, slightly unknown. The email I got from Homes England did reinforce the fact that they were just talking with shared ownership providers. They were talking with UK Finance and also the Building Society Association, the Association of Building Societies. So the discussion's happening, but it's yet to hit the ground floor. Of course, there's plenty of time before bricks come out the ground, so there is time. On the other side of the coin then, how are providers going to fund it? The output from the technical consultation did say to be aware that the 10% is mandatory. I do recall when we were between the consultations last year, there was a lot of speculation around the sector whether it's going to be advisory or strongly encouraged or mandatory. It is mandatory, we have got to do it. But the technical conversation did say be aware that when you put in your funding requests in, but also be aware that not everyone's going to go at 10%. And I think that is the real unknown, because what will be the change in the blending? There's a lot of people I've talked to who think that actually it's going to push the shares right way down. Other people are saying when you get to that level, there's probably going to be other checks and balances that will kick in place, like existing debt, and it won't be such a swing towards the lower shares on balance. I think the only answer is we don't really know. So still a lot of unknowns around this one at the moment, but you know, I think we need to be under no illusions. The real policy drivers here are the lenders, and if they won't lend on it, it ain't going to happen.
Okay.
Yeah, agreed. Yeah, I think that's one of the key questions, isn't it, in relation to what's coming through from the market. One other thing we would comment on in relation to the mortgage market is at the moment, we're still seeing record numbers of shared ownership sales going through as a firm. Clients are still having high numbers going through. One of the, and this is very much a legal one, a few lenders seem to have adopted a slightly different approach in relation to a requirement for the RP to actually be registered at the land registry. Quite often under contract structures, the RPs may only be purchasing the units just before they're completed or as they're completed. The land registry currently has delays. I mean, they're quite long delays. It's from 6 to 12 months delays in relation to registration, and some lenders are asking for that. So that's causing a few other challenges. So there'll be a question as to whether that's still carrying on as well, to see what the appetite of the lender market is going forward. Anyway, so that was just picking up on the first point.
We've got a couple of questions here, if I could just sort of jump in there. So one from Chris here: isn't the first tranche still based on affordability? So if they can afford more, they have to buy more, not just the minimum.
Yeah, if I can chip in on there, that is absolutely correct. And Homes England also said in their email to me that actually they are looking at the sustainability calculator and just see if there are any mods need to do that in discussion with the lenders. So absolutely, as is with the current programme, the purchasers need to be encouraged to buy as much as they can afford, not just the minimum.
Okay. Another one, Jay Sedenk. Jay here. Hello, Jay from Cobalt. Still linked to affordability of purchaser. They can just state 10%. It has to be based on what they can afford, which may be more.
Yep.
And then one from Joel here. 10% is minimum mandatory, but presume the share that purchasers buy will be based on their own affordability calculation as previous.
Yeah, yeah. Those questions are all saying the same, aren't they? And that's absolutely the case. You know, best use of grant. People need to be encouraged to buy what they can afford, not just the minimum.
Okay, thank you. Right, would you like to move on now, John?
Yeah, sorry, I'm conscious of time as well. So yeah, I'll pick up. In relation to the next point is on the staircasing. The previous slide still, please. Actually, sorry, Christopher. I just wanted to touch on the 1% staircasing. So there is the 1% staircasing for the first 15 years, 1% going through, looking at HPI linkage back to, so the house price index linkage back to the original sale price. There is a question mark in relation to how that is actually going to be applied. That I think is one of the complex areas for the drafting, to introducing a staircasing system for 1%. Some of the questions that I'm aware of in relation to how do you document that? So if a shed owner in 5 years' time looks to sell their interest in staircase to 100%, making sure that everyone's got correct records as to what was and was not purchased on the 1% mechanisms, and how do you actually track that through? I think there's quite a heavy investment potentially required by a number of RPs in relation to a technology solution for this, as to how do you facilitate that going forward. There's also the issue in relation to HPI itself. If there's a fire sale on the site next door, will that impact upon the index that you'll be applying? What is the index you're going to be using based on housing tenure and location? I don't know, Greg, if you had any more on the 1%.
Yeah, no, those things you pointed out are just the exact same things that I'm hearing in the discussions. The housekeeping one is a big one, because there's no obligation for registration, and I think the model's talking about just a memorandum of sale. But you've got to look after that and keep that. And I think the technical solutions will be the ones that will help here. You know, the technical providers of software may be able to help. I know STS has Home Track, but there are other solutions available. I chip in. I think for me, the question is, you know, how popular will it be? Because yeah, in theory, you have a good week on a scratch card, you can buy a few more bricks. I just don't know whether that's going to happen, and it would be keen to hear from the sector on that. I'm just going back to when I was in mainstream. You know, I think before I recall, a 10% staircasing was rare. Okay, now that was one that involved costs, and so people, maybe that's the reason people decided to wait till they could do 2025 or full staircasing. But I think it's great that people have got the ability to do this. My gut feeling is I don't know if it's going to be very popular, which means actually there'll be a housekeeping and technology infrastructure for small beer. So I think it's something we need to be aware of.
And then the other point, so this slide's just picking up the big three ones, as it were, is the repair position, the repair period for 10 years, obligations upon the shed owner to be able to maintain certain elements, which were clarified a little bit more in the consultation, but the drafting still needed to clarity on that. And then also the repair obligation in relation to the RP landlord position. There's also the figure in reference to, I think, £500, isn't it, in relation to potential contribution on an annual basis. The big questions, and apologies, I don't have any further answers on this in relation to how is this actually going to be managed? What is the cost benefit analysis of being able to ascertain who caused what damage and how versus the potential contribution of up to £500? I think these are things that are going to raise a number of questions internally with organisations for their own policies for dealing with it going forward. I don't think the lease is going to answer it all for everybody in a clear cut as to how you deal with this. And so there's going to be a question of interpretation. I don't know what you think, Greg.
Yeah, this is the big one, isn't it? There's been a little bit of clarity since the initial discussion paper, which I think was referring to essential repairs. And now there was debate going on, well, how do you define what's essential? If you've got an upstairs loo and a downstairs loo and one's not flushing well, is it essential that the landlord chips in? I think obviously we would. They're focusing a bit more now on I think it's Section 11 of the Landlord Tenant Act, the requirements in there as a focus of what we need to do. Discussions are around, there's a lot of admin work here. You know, I've heard a number of people suggesting they might just give the 500 quid as a matter of course, because it'd be cheaper than sending surveyors out and all that sort of thing. I think charitable associations might struggle with that, but I'll bow to the legals on that one. Maybe you want to comment on that, Jonathan. But what I would say is I was slightly surprised that we had this fixed 500 quid. I always thought it should be based upon the amount of shares you actually owned. And when I looked at the detail of the output, there's only 10% of the people who contributed to the consultation agree with my position on that, maybe because it's too complicated. But yeah, if I'd say bought a house or a flat in where I live in Southampton, 230,000 for a 2-bedroom flat. Actually, let's make the maths easier. 200,000 for a 2-bedroom flat on the edge of town, brand new. And a year later, I come into some money. Ordinarily, I won't be wanting to staircase out. But what if I only staircase to 99%, and then for the next 9 years? My rent's going to be 60 quid. 60 quid, a fiver a month for a pretty good home insurance policy. Now am I overthinking this? Will people do that? I don't know. if it had been apportioned to the amount of shares I owned, you could go up to £1,000, and then I'd only be saving a tenner. So I don't know. It just seemed an odd way of doing it, but you know, that's the way we're going. It's the £500 rolling over by 1 year if need be. Again, a lot of administration. It's keen to. I was good to see that you can offer the DLO service. You've got it. It's not obligatory, but they must. If they don't choose your DLO service, they must use one of the approved constructors, which is, I forget the name. It's not Checkatrade. It's one of the others. The government approved one, and I'm sure someone will be able to chip and tell me who that is. But they can't just go to their mate down the road to get the work done.
Got it. Okay, a few more questions here and comments. One from Ben here. Appears the issue is not the traditional lenders, but the prospect of unsecured lending is now possible. So do Devonshires, etc., think if unsecured lending is used to buy low tranche, this is not as risky as may first appear to the RP, as MPC won't apply? Other than the sustainability assessment and anti-money laundering, what other ways can the sector restrict unsecured borrowing being used to buy? Presumably, we can also ask someone who can afford it to buy a higher share with a mortgage than choose to buy with unsecured.
Yeah. On the unsecured part, money laundering is the key one here in relation to other funds coming on board and what's happening in relation to that. Money laundering concerns and obligations, I think, are on the increase. They're becoming more under the spotlight as well. We're seeing it become more and more of a question amongst boards within organisations in relation to their procedures for it, the robustness in relation to those. I think, Greg may correct me if I'm wrong here, there used to be more of a reliance on the external consultants in relation to the money laundering position, but that is changing with a number of organisations wanting to understand more what is going on, mainly because of the public perception and everything else that may come out of it in relation to it, as well as complying with the regulations. So I think unsecured does raise a lot more questions in relation to, there is inadvertent money laundering at times, which may pop up that people aren't always aware of. But money laundering itself, one of my colleagues, a number of my colleagues deal with on that. That is a good few hours. I don't say good, it could be quite a depressing few hours, but that's a few hours long talking about money laundering in relation to that. My concern is potentially more actually as I sort of alluded to, the more sort of credit card rate style mortgage market coming on board in relation to this, particularly if you look at the right to shared ownership. If people are looking to exercise the right to shared ownership, we've seen it before when it comes to people exercising their right to buy when there's been pilots, etc. Other lenders or organisations coming on board with different kind of downstream funding solutions, which can create some undue terms. So it's one of the things I think we're going to have to be wary of as a sector going forward.
Thank you very much.
So I've got a question. Just roll back very slightly. I did look it up. It's actually Trustmark that the contractors need to be registered with, which is a government-approved body. I thought it was Checkatrade, it's not. It's Trustmark. That question was very interesting, and something's come out that I'm just slightly unsure of, and I'll be interested to hear John's perspective on this. I thought the question suggested that if it was unsecured lending, then there would be no need to deploy the mortgage protection clause. Now, I know we get to see the lease, but yeah, John, could you talk to that one a bit, just to confirm that?
Well, if there's unsecured, it's what the unsecured lending could look like could be various different kinds of options and arrangements in relation to that. I think that comes back a question in relation to affordability, because if there's money coming on board to a prospective purchaser to fund, say, to get to the 10%, does it raise questions in relation to their ability to afford going forward? Because if there's unsecured lending, what are the terms in relation to that repayment? Potentially on unsecured lending on other parties being involved, that could give rise to beneficial interests, which could bring in questions in relation to what happens if there was an exercise and a forfeiture arrangement. That's why everyone always tries to make it nice and clear, hence the legal charge and the normal mortgage route of who's involved and what's at stake in relation to that. There are ways around dealing with it. I'm sure everyone is aware, but it is definitely a rise in unsecured potentially rate, which you're notified about, would start to raise more questions for me as an organisation in relation to who you're dealing and what's the funding pool going on there. It also links back to affordability, doesn't it? Normally unsecured, incorrect on this, and I may be wrong, please. Unsecured quite often maybe raises more question about the longevity of being able to afford the rental payments due under the lease. And do you have a higher risk there in relation to what's going on? I think there's a lot of confidence taken, isn't there, from the checks and balances that lenders would put in place normally for their underwriting?
Yeah, and I must say unsecured does scare me. And in the point about the NPC, because that, that is secure by the back door, isn't it? So and I think as a provider, we'd be very nervous about having a de facto secure assurance to unsecured providers. So I'm keen to see how that dresses out. In terms of marginality, that people who need to resort to unsecured lending, I think there's an issue there. And again, the robustness of the sustainability checks need to be sort of strengthened, I think, and we'll be looking for the specialist mortgage brokers to our mortgage teams to look at that. Can people afford to pay this? Are we getting people into a situation that they can't sustain? I think there's a degree of nervousness there, but clearly the government doesn't want to put caps in the way, and so this will be coming our way.
Okay, this is my moment, Christopher. Next slide, please. Unfortunately, it doesn't have a graph on it. I'll quickly canter through these because I know there's quite a lot of others to go through. The lease length, the new number of 990, not 99, not the 250 that some people were moving to already. We have 990 years. I still await an answer to the question as to what happens if the head lease or the interest that the RP holds upstream, so the head lease arrangement is not up to 990 years, and what's going to happen in those circumstances. We await a response. We have been advising clients that anyone who is currently taking a leasehold interest in units that are due to hand over anytime soon engages quickly with those conversations with the relevant landlords, developers, to ensure that lease lengths are varied to cover 999. I think 999 has been the desire for a long period of time. Strangely, it's certain organisations, statutory bodies, local authorities are the ones that always seem to be a bit more hesitant in some areas to granting transferring freehold interest or granting leases longer than 250. So actually those are the bodies. Homes England itself, I suspect, maybe having some conversations with some purchasers in relation to extending leases under their development arrangements. So that is all something I'd recommend is looked at now, and programs are put in place to deal with variations early. While arguably this only relates to your shared ownership lease under the new grant scheme and going forward, which I'll touch on in a moment, I think the market conditions and also the perception and the leasehold reforms that are coming out anyway, getting a foot ahead of this and looking at some of your stock and or more recent stock may be advisable, because it could be more effective to deal with changes now, shall we say. The new model form lease is to be applied on all, the guidance seems to indicate it's going to apply on all new 106s in relation to new plannings that are granted going forward, and also, of course, anything that's delivered in accordance with the new programme. There was reference to the fact that if there was an outline consent already in place and then detailed consent is obtained later, they wouldn't be looking for the transition period provisions to apply, and therefore you could apply the old shared ownership model form of lease in relation to those circumstances. I think the question that will come up is if it's a multi-phase development and you're doing old form on phase 1, but you know you're going to be doing new form on phase 2 6 months later, what's actually going to happen to the practical sales market, and also from an admin burden? Is it going to be better just to bite the bullet in some cases and move to the new form of lease if that's what you're doing as an organisation? But something to consider, and that's little links onto the market position. I suppose the question is, which one would you rather buy, the 990 or the 125? And the 990 with the free 500, sorry, I shouldn't say free £500 a year, but the £500 a year contribution to repairs. NPC we've already talked about. So I've just got one more slide. So I'm very conscious of time. Apologies to colleagues.
No apologies at all. There's plenty of engagement. This is what we wanted.
Well, this is really good.
And we've got more questions to get through as well.
So some of the other factors I think I've already touched on these. Leasehold reform. So the phrase common hold has popped up its head again, and the Law Commission a number of years ago referred to potentially looking at a change to the lease structure. What happens in relation to ground rents? These are going to be continually moving. I think it is going to be very difficult to make a massive change in relation to how leasehold tenure is dealt with, to be honest, in any short term. So therefore the confidence, and also, as I say, the volume of sales we're still seeing don't seem to be effective. But what is to consider is lease term, so 999 years, and also looking at ground rent positions and making sure that those, I would pretty much be so much to say going forward, there's got to be some really extenuating circumstances as to why any ground rent is in any new form of lease going forward, if you're involving it for an affordable based product. I think that's been adapted by the sector for a while, definitely over the last 12 months, but it's something to be working on. And also, if you have an ability now to apply pressure upon a developer, there was, of course, I referenced it, the Competition Markets Authority's decision in relation to Countryside and Taylor Wimpey. There are other conversations ongoing in relation to developers and looking at ground rents. I don't think there's anything new on that. It's just the government signposting that they will be looking at something, saying no more going forward. I think historically there's going to be something to rectify those ones that may have issues so far. And then finally, planning changes. There were a lot of white papers at the end of last year, he says, having to read a lot of white papers and comment on stuff. And the planning changes that are coming through are still gaining speed. So there is a question mark over relation to what will actually be in future 106s, even though they referenced it concerning the delivery of affordability. What will that look like and require? And actually, will people be looking to deliver more properties that were targeted for market sale as additionality as affordable and looking to apply on those and then be back to the grant conditions? This one's here more of a plea to make sure your organisations are engaging when the time happens for local plans, to make sure, because they will be the guiding document really for planning decisions to a degree going forward, to make sure you engage with relevant boroughs that you work with, to make sure that affordable is still signpost clearly there for objectives. And then while we're waiting for the lease and the capital funding guide, there's then also going to be the slight little, well, I don't know, Greg, whether you've heard or not, whether there's going to be the little tweaks from the GLA as well, because they like to do things just a little bit different.
Well, they always do up there, but it's well out of my manner, that one, so I don't have the detail around that one. In terms of the long lease, I think it's an interesting one because it was January when Generic announced this one. And only the previous month there was the Panorama program, which I think really rubbed our noses in this whole lease length thing quite a bit. And I think it's almost a little bit of a lesson for us to learn, because, you know, why did we as a sector run to the lowest common denominator? I think it's 5.3 of the capital funding guide clearly states that the 99 years is the minimum, and yet we all adopted the minimum. So, you know, I think we had this coming.
Okay. Right.
So a bit of a canter at the end there.
That's good.
Eagerly waiting to hear the position of an RP. Oh.
Yes, absolutely. So we've got Jeanette Grady, the Group Head of Sales of Taurus. And Jeanette, if you'd like to join us, and I'm just going to line up your presentation now. Jeanette, thank you for joining us. Now you're going to be providing us with your reaction, how this has changed your appetite. But I guess before we do that, is there anything you'd like to sort of bring in there based on what Greg and Jonathan have just said?
Well, obviously my presentation covers a lot of what has already been discussed, but I'll pick up some key points. So around the changes, so we talked about the £500 per year for the first 10 years for repairs, and whether we would just gift that to leaseholders. We have taken advice on that, and we've been told, no, as a charitable organisation, that's not something that we would advise you to do. Timescales are the big things for us with repairs. So we note that the proposals are, we have to reject or approve a request for return costs within 7 days. We have to pay within 21 days. So it is a lot of admin for something that we've not done before. Other elements of the new changes, so the maximum of 3% rent. We've always charged 2.75. We took some advice from the sector and said, what are others intending to do? The feedback was generally, we're going to stick with the 2.75. So consistently, that's what we've agreed to do. I'm not going to pick up on right to shared ownership. I think my team will be picking up the new model. So that's where I'm going to focus my time. So if you want to jump to the next slide, Christopher. I'm just conscious of time as well, so I'll try to keep this.
Don't worry, we're still okay. We've got a good 22 minutes, so don't you worry.
Okay. Okay, so appraisal assumptions, so conversations about what our RP is going to do about this. So what we've done at Taurus is we've made an informed decision. So last year, 2021, we delivered over 160 legal completions. We look back at the percentages we'd achieved. It was our highest performing year to date. So yes, record sales for the team. And of those sales achieved, 40% of those sales were at 25%, and another 11% were below our appraisal assumption of 40%. So you can see there 50% of our legal completions were below our appraisal assumptions. So what we've done is we've gone for a blended rate. So within our appraisal for the new model, we're looking at an average first tranche sale of 32.5%. It's a best guess, but it's based on what we delivered last year, so we feel like it's an informed decision. So we'll see, we'll review that annually, we'll review our assumptions annually, and we'll make changes accordingly. In-house systems for us, we talked about technology, it is going to cause us issues. Does our systems have the ability to deliver? We've trained our call centres over the last years, decades, not to take repairs or log repairs for shared owners. We're now going to turn that on its head and say to them, no, actually for this group of shared owners, we can register repairs with our DLO. We need the systems to do that. Our approach is going to be that we're going to look at setting up a different tenure. So we'll have 2 shared owners tenures, so that call centres and other teams will be able to see clearly and identify who is on the new model and who is a former shared owner on the older terms. Processes and resources, so it doesn't just impact on development and sales, as we know. So what we're going to do at Taurus is we're going to set up a focus group, and we intend to involve our finance team, our IT teams, our call centres, so that everybody has got an overview of the impact that this has. So it's all well and good the sales and development team understanding the changes, but the leasehold team are going to pick up the majority of the issues around staircasing and repairs. So we just need to make sure that everybody's on board. Are our processes fit for purpose? If not, let's adapt them slightly, or we might need some new processes. So resources is the big one. It's a little bit unsure, you know, what is the take-up going to be like? We don't really know at this point in time. So it's preparing the teams to deal with that additional workload without knowing what that workload will look like at this point in time. Advertising and marketing campaigns, what we've decided to do is we're going to keep it very clear and consistent. Our marketing will be around shared ownership rather than the nuances of the particular product. So for each development, we'll develop a suite of marketing literature that will go into more detail about what that person is purchasing. And if we offer 10% share, if we don't. So it will be, we'll continue as we are with the marketing for the time being, and as people's inquiries come through for particular developments, we'll go through the detail with them and the nuances for the product that they've applied for. Okay, and then I was going to say, is there any questions, Christopher?
Yeah, there's so in terms of nothing on your particular presentation, but we've got about five questions from earlier we need to get to once we've made our way through.
Okay, well, I'll just finish off with my last slide then. So demand, do we think there'll be demand for the product? We definitely think that we'll have increased inquiries. The team deal with around 3,500 inquiries for shared ownership annually at the moment anyway. We've got a programme for the next 5 years of over 3,000 units for shared ownership and rent to buy. On some developments, we will be in competition with ourselves. So we'll have early phases using the existing model, and then phases 3 and 4 years down the line, where obviously we'll be using a different funding stream. So we'll have a different product. So it's how we approach those. We don't have the answers at the moment, so that's just something that we're considering. Affordability, it's been raised. You know, this is something, we have 25% sales now. Customers will inquire about this 10%, there is no doubt about it. They will be interested to understand the lower share and the ability to claim for repairs as well. But that affordability assessment is key. We will look at their individual income and expenditure, and we will tell them what we believe is sustainable for them, and that's what their share is usually based on. So just because we receive increased inquiries for 10% doesn't mean that they'll convert into 10% sales. But you do have all those added issues of lenders and whether they're willing to lend and unsecured debt. Internally at the moment around unsecured debt, Taurus are just trying to understand what our position will be. Will we accept it? Will we have a policy to say that we don't accept it?
So you will be offering 10%?
We will be offering 10%. It's going to be mandatory for the model. So we will be offering 10%, but whether we allow that to proceed with unsecured debt is something that we are yet to iron out internally.
Okay, thank you.
Okay. And staircasing, you know, historically, leaseholders have said that staircasing is unaffordable once they're in a property and they're paying a mortgage and a rent. So reducing it to 5% may see an increase in applications for staircasing. 1%, again, issues around admin and how we are going to deliver that and how we are going to monitor that. Staircasing for us, so as an organisation with over just under 1,000 shared owners, we had pre-pandemic around 13 applications for staircasing. That quadrupled during the pandemic. So we've seen a huge surge in the number of shared owners wanting to increase their share. Historically, majority of staircasing cases have gone from their tranche and their interest up to 100% and outright. Ongoing cases that we have at the moment at Taurus is a 50-50 split. So we have 50% of those applications looking to staircase out and 50% just looking to increase their share. And then consistent messaging for us, as I say, we've talked about how we are going to communicate with the applicants for this. Basically, we just need to make sure that our standard documentation is very clear. We're looking at a document to be developed that will explain the product, will explain how things will work internally, and we're going to ask purchasers to sign that. So we have documentation and evidence that they have read certain literature that we have given them, and they understand what they are buying into as well, just so that it's very clear. And then lastly for me really is the unknowns. There's a lot of unknowns at the moment. All we can do is basically prepare ourselves and see what comes. So we will be learning on that journey. We'll be tailoring and tweaking processes and procedures and making decisions once we see what the take up and the demand is like for the product.
So there's a lot of questions I've got here, Jeanette. When are Taurus likely to launch their first scheme on the market through the new model?
We think it will be around 22-23 or 23-24. That's looking at our programme at the moment.
Okay, thank you very much. And how is the £500, that was from Shaheen, thank you Shaheen. How is the £500 going to be managed if the repairs aren't logged via housing management system, i.e. through the customer service team? Resident organising their own repair and reclaiming? That was from Caroline, thank you Caroline.
Yeah, I mean, that's it. There are two ways to deal with this. As long as the customer has Trustmark contractors, they can do that work themselves. The difficulty is around repairs as well, especially with new build properties. We don't want to miss out on our defects liability periods. We'll have elements of those properties that are covered under warranties. So it will just be a case of implementing a process that will require the customer to contact us and give us an explanation of what that repair is and then how we intend to deal with it going forward. But, you know, it is early days and we don't know what sort of repairs will come to us. We have it now on new builds, you know, once people have moved in with snags and defects that haven't been picked up prior to moving. So we definitely know that's going to continue. It's just what approach we adopt to deal with that going forward.
Thank you very much. Lots more interest here. Could you please explain further on advertising and campaigns? Is it going to be different from the current process?
Our
That was from
marketing
your
campaigns.
Yes, Connie? Yeah, as in your current process, you say it's going to be the same, or you're just still going to be focused on shared ownership rather than necessarily the new features.
Yeah, so our marketing campaigns now launch development as shared ownership. It's only if the interest levels, all marketing will commence at around 40%, which is our appraisal assumptions. If we use any monetary values in our marketing. It's only as demand dries up on developments that we actually market at that lower share. So initially, all marketing campaigns will just be focused on the fact that it's a shared ownership product. We may tailor that as we go through the process. So 6 months down the line, we may choose to, on those schemes where we're offering 10%, we may choose to tailor the marketing to promote the value of that 10% share. But at the outset, our marketing campaign will be just generic around shared ownership. And as I say, once those leads come in, we'll then provide details around the individual product on that development.
Can I, Chris, can I ask you a quick question? Can you make that work viable for those, or how many can you support in your program of the 10%?
We've taken a blended approach. So I gave you the figures earlier. So that of the 160 we've had, 50% were below that 40% appraisal assumption, but we still came out with an average for the year at 40% because we had an extra care development in there who predominantly buy higher shares. We had a development that was in a popular area and quite an affluent area. So we'll just monitor that, Andrew, and annually we'll have to review that. But it's a model where, as with 25% shares, we can't reject a 25% applicant if their affordability assessment says that is sustainable for them. We wouldn't allow 10% across a full development. We wouldn't be able to do that. So we'd have to look at that, and we'd monitor that as the sales were progressing, looking at how many and the share value on a scheme by scheme basis. We do that now. We try to broadly come in at 40% on our developments.
So on that 10% then, are you saying that you are now putting in some staircasing in the future that will make it work? What's the offset?
As part of our appraisals for this first year, no, we haven't assumed any staircasing, but that will be reviewed as part of our appraisal assumptions annually, and we'll pick that up depending on the activity.
Yeah, which is the right way to do it, as we would always say, is leave staircasing out because it's a future thing and it's a bit of a hope part of you. How would the conversation go if you're advertising shared ownership in the next year, and then the marketing of that sector is going to say there's a new product out there saying 10%? How would customers, clients, how are you going to deal with that mixed message? You're not offering that till 2023-24.
I think it will be that we're not offering it on this development because that development is funded through a different funding stream. So we will be able to tell them which developments we will be able to offer that 10% on. So our website has coming soon schemes. So in a particular area, we'll be able to say if we have any developments that are imminently coming to market, that will be offering that 10% share.
Yeah.
I've got a question for you here, Jeanette. It's from Kimberly. Why do you feel that staircasing requests quadrupled during the pandemic? What's your feeling on that?
People were investing in their homes. They were spending a lot more time at home. People just, it was more secure. I suppose people buying an extra share, reducing their outgoings by way of rent. There's no clear way to monitor that at the moment, but we can ask our customers and find out. But as I say, the feedback has generally always been that it's quite expensive to staircase. So we were surprised to see that influx of additional requests for staircasing. I will say people inquired. That didn't necessarily result in all of those people then going on to buy additional shares. So people then, once they knew what the value was, some people couldn't, it wasn't sustainable to buy an additional share. But I think the biggest thing for me was the increase in people increasing their share rather than staircasing out, generally to increase from 25 to 75, you've usually had a change of circumstances. So a 50-50 split is quite unusual for us, I would say.
Thank you very much, Jeanette. We've got some more questions here. I'm just going to go back a bit earlier. This is one from Jay again. Is there a view on who pays legal fees for these 1% incremental increases every 6 months, for example? Jonathan? Is there anything legally? Greg and Jonathan, I'm looking at you on this one.
Yeah, at the moment it's supposed to be reducing the costs and exposure for it on the 1%. So at the moment, from what I've seen, and we haven't seen the final form as we said, but what we've seen is that parties responsible for their own costs. I think the costs being levied by RPs upon tenants to pay for them are going to dwindle in relation to that 1%. I don't know, Greg, if you've seen anything further, but I think most people aren't modelling they're going to get cost recovery.
That's exactly what I'm seeing. Everyone's responsible for their own legal fees, and with the requirement or the lack of requirement for registration and going just through a memorandum sale, I'm just wondering how much legal input there's going to need to be there during the staircasing process, or whether then that all gets wrapped up on sale. I mean, it's an area that's a bit grey to me, and I don't know if you've got any further thoughts on that.
I'm sorry, I was just thinking to say the bit to me, as you say, is actually when it comes to final sale. Yeah. So if there's a sale at a latter point, or someone looks to staircase to 100%, that's perhaps when more eyes will focus, as it were, upon it. And at that point, there'll be a question of the resident maybe saying, oh, I staircased 1% last year, I'm sure I did. And then there comes a question as to who's going through account records, who's looking at this, where's that going? Because they will pop up those odd ones. And then there comes the cost benefit analysis. I mean, just me off the top of my head thinking about it, Jeanette, someone in your team would get a request, they then fire it to accounts then look into it, fire it to someone else then fire it back, then there's the correspondence with the tenant, and then all of a sudden you're up to 20 emails and you've lost 20 hours. And there's going to be that kind of, at what point is this actually worth pursuing or not question.
Yeah, and I think it's the technology side again, isn't it? We need a robust system where we record tranches, whether they be 1%, 5%, 10%. We need some way of recording that, so we've got a clear audit trail of those people who have actually gone ahead with those 1% tranches.
Yeah, and I wonder whether is it going to be a case of annual statements going out, as perverse it may be, just reconfirming to residents your share is X still. Those kind of things. Just maybe, I don't know. Yeah. I think it's going to be a little bit of trial and error. But yeah,
I was gonna jump in there, but I kind of resisted there a little bit.
I know what you're going to say, Andrew.
You know, we at SDS provide a really good system, and I'd correct Greg earlier on, but it's not called sales home track, it's home match.
Oh, Freudian slip.
Yes. So yes, SDS provide home match, which is sales software solution that tracks, follows, and monitors, you know, all the attributes associated to the product and share, and happily to talk about that to any of the clients out there.
Yes.
But that's absolutely a side thing, as we're not here to talk about that.
We're not, but it doesn't hurt. I've got another question here. So would boiler servicing be part of the £500? That's from Chris. Thank you, Chris.
Cool.
I can comment on there. The legislation is quite clear that it's the responsibility of the resident to do the servicing, get the servicing done in order to benefit from any payment on repair on breakdown. But it's an interesting point there, because my particular boiler came with a 7-year warranty. It's jolly good. If I chose to get the person who put it in to service it, the company to put it in that serviced it, they would, on their liability, extend that for full 10 years. So there's a bit of a nuance there. How, you know, can you insist on your customer going to the installer to get the annual servicing to get the full 10 years, which takes you out of the, or can, you know, or if they go to regular trustmark servicer, you might be in for the liability of the final 3. I think what RPs ought to do is talk to the boiler manufacturer and say, come on, you're getting a lot of business, we want a full 10-year warranty on this.
Thank you very much.
Sorry, Christopher, can I just pick up just a comment that Jenna made earlier, and I think just following themes, just one of the ones, and it still needs to be bottomed out, but my construction colleagues would shoot me if I didn't highlight this, that if people undertake works on properties if there is a defect or an issue or something that needs repairing is identified, quite often what happens, something gets pulled out and then something else gets found behind that, and then something else gets found behind that. It's not all the time, I'm not trying to, but sometimes that can happen. And there comes a question actually whether the person who did the first bit of works, having invalidated any potential claims in relation to the other bit of works. And that is still the big headache that I think people are going to have to try and figure out how they're going to do it in their policies and procedures. And I'll be honest, the shared ownership full model lease is not going to cater for that. There's not drafting to cover that. So it's how our organisation is going to implement it is going to be the key one. Sorry, I just flagged that.
No, thank you. That's great. I'll just try and get through these. We've got a lot more questions flooding in. We are on a site with a scheme with shared ownership in it, funded through the HRA with right to buy receipts, no Homes England funding. Are we obliged to follow the standard Homes England lease, either the current one or the new one?
No, my understanding is not. If it's not part of a registered programme, you don't need to do it, as is the case with the existing programme. So people who fund through the HRA can choose to require a local connection, for example, which you can't if you're part of a registered programme.
Okay, thank you very much.
Do you know with that one, Jonathan?
Please.
Sorry, I was just going to say, for consistency, we adopt the same model lease for all of our schemes. It just helps with the management longer term.
I was just going to comment, yeah, consistency wise, normally see people do that. Also, there is the point if you are actually representing the units as part of your program, but non-grant units within the system as well, it can create some confusing conversations with your local Homes England representative, shall we say, if you haven't followed the form. But that's another grey area.
Yeah, I think for RPs, if it's part of a registered program, even if there's no grant in it, I think we would be obliged to follow the new lease. Certainly, when they started dropping in local connections and no bedroom restrictions, it was quite clear, non-funded, or 1 in 6 without funded, you still had to follow the rules. Because let's face it, grant is not the only benefit we get from the regulations, if we get good bond rates and that sort of stuff. So I would be surprised if that's not an ongoing requirement for the new programme.
Thank you very much. I just want to say we've hit 11 o'clock, but we've still got a number of questions here. Is everyone okay to stay on for a few minutes to get through these questions? If not, that's fine. We can come back to it. Okay, great. So this is one here from Ben on repairs. On repairs, what Homes England have included appears to be works that would typically be expected to be covered in the new home warranty. So is the main issue about ensuring the correct reporting so as not to invalidate warranty and the most likely spend of the £500 allowance on excess for LABC or Premier when it claims fall under the minimum works cost for NHBC, which is circa 1850. Also, consumer protection regs risk to providers of overselling as not as good as it first sounds.
Jonathan, I think.
Yeah, well, you beat me to it. I was going to say Greg. Quite a bit in that one. So I think, sort of very quickly in summary, I think it's a case of the warranties are going to have to be considered. Warranty wording probably needs to be updated in consultation with NHBC, LABC, and all the other various names that are out there in relation to the terms of warranty, in making sure that there aren't accidental trips. Picking up from my comment I made a few moments ago. If I was a warranty provider, I'd be quite happy at the fact that they know that you're already paying over £500 and so other stuff's being done, and all of a sudden snagging items may get picked up as well. There is also defects periods. So we've gone from a shift of 12 to 24 months on defects when dealing with contractors and house builders. You don't really want to be invalidating those, but the question is, will your defects procedure actually align with your obligations in relation to the shared ownership lease? So that will need to be updated, which will mean, I'll be honest, some painful conversations with some house builders because they really like defects procedures. But I think there's various bits in relation to that. I can't really give an answer, say this is what you would do, because there's so many different strings, and you just need to make sure, as correctly highlighted, don't get tripped up by those various elements.
Thank you.
Yeah,
I'll
just add to that. I think the key thing here, as we've mentioned a couple of times, it's the housekeeping, it's the administration, because yeah, a lot of this stuff we're worried about is warranty covered. We just need to be a little bit more on the ball there. You alluded to it, John. There's still RPs I work with who think the NHBC warranty requires the builders to deal with defects for the first 12 months. Of course, we know it's 24 months, and they say, yeah, but we've got 12 months defect period. You know, it's 2 different contracts here. So I think it's just getting underneath all this, getting the housekeeping put in place, and it may be, you know, it's not going to be as bad as we think.
Thank you very much. So I've got a question here from Liam. Will there be an option to increase the unsold equity rental from 2.75% to say 3% to mitigate against the lower 10% sales equity?
Well, yeah,
I
touched
point,
and I picked up on. So Jeanette, you go first.
All I was going to say is I picked up on this earlier. So we took some advice from the sector and peers and said what was the approach others were adopting. And although we've always been able to go up to 3%, we've kind of agreed that then we will continue with the 2.75 to make sure that the product is still affordable. So that will be our approach going forward. And that was the message that we received from the sector as well.
There's a little nuance in it. I'm slightly curious about, because yeah, the 2.75 was always the number one. We could go to 3%, but we had to have a little discussion with our housing lead and that sort of thing. In the consultation, there's no mention of 2.75. It's only 3. So I'm just wondering if they're planting in our mind that actually we might need to start looking at it, because they do. Well, they say when you're bidding, take account of the costs and the lower shares, that sort of thing. There's a warning in there, and that's not to overcook it when you do your bid. So I'm just wondering, I don't know, I'm curious to see how this rolls out. I'm just wondering if they're thinking about, actually, you know what, your bid should be around about 3% now to start paying for this. And certainly my previous organisation I worked for, we'd be going in at between 2.25 and 2.75, depending on what we need for the scheme. So I'm waiting for someone to say, guys, go in at 3% because we ain't got an endless bank account. We need you to get a little bit more out of the customer. I don't know.
And forgive me, this may be, I think it's definitely more yourself sort of area, but one thought is the cost of build is going up, and the requirements for build and the requirements for inspection and the requirements for delivery, that is going in one direction. Land is still always going in its same one direction upwards. So the bit that normally, from what I see, gets squeezed is the percentage multiplier you do on the shared ownership to make it affordable because of the total cost and value of it. So while yeah, you may be able to run to 3%, with everything else getting more expensive, I question whether that will actually happen in reality on schemes, because it's not as easy a switch to flick from what we're seeing.
That's a good point.
From my perspective, a lot of the clients that we've been talking to are considering it. I was quite surprised when we did a bit of benchmarking in the Southwest. That a lot of clients are still using 3% already. So there is, I think, from an SDS point of view, we'll keep an eye on this and we'll do some benchmarking on kind of shared ownership activity across the sector, and we'll hopefully have some good data to come back to in a year or two time.
Brilliant. So just a couple more here and then I will release you all. Who pays for the valuation? That's from Chris. Who can pay for the valuation?
For the micro staircasing, the intention is it's done on HPI. The original Red Book valuation is the base, and then it's an HPI inflation after that. So effectively, it's the administration cost of the RP.
There is a right for the RP to be able to pay. There's a right for an RP to be able to pay for a valuation if it wants to. So if, just one of the comments I made earlier, if you're looking at your HPI data, the site next door was a fire sale, there's a delay in registration, something else is affecting, so actually you think there's a massive skew on the land value, then you could pay for it. I've got to be honest, it must be a high value unit for you to be blowing about a discrepancy on a 1%, but.
Got it. Okay, thank you. One here from Shaheen. Are HAs able to reject purchasers who want to purchase the 10% if we are averaging below our appraisal share? That's a big one, isn't it?
That's a massive one, and I don't know, because I think the thing is, on the old model, it was strongly encouraged. You had the blending, didn't you, from 25 to 75, strongly encouraged. The language is a little bit more direct now, and I'm just wondering if you went to your lead and say, you know, we sold too many 10s, we've got to do some 20s and 30s now, what the reaction would be, and I'd be interested to hear other people's opinion on that.
Jeanette?
Yeah, I think we probably go to our local Homes England rep and have that conversation on a scheme by scheme basis. We monitor our sales quite closely, so as our percentages were coming in, we'd look to seek some advice on that. And obviously, you know, if we're appraising at an average of 32.5 and the majority of cases are 10%, it's going to be a huge difference for our sales income as well. So I think we just do that on a case by case basis and go for some advice.
And you know, Homes England and HCA before them, they've always been pragmatic on this sort of thing. I think the thing is to have the conversation. You know, they don't want our piece to go bust, and they know that we're all in new territory here. We do not know. I don't think we really know how that purchase demand blend is going to roll out. So I think, you know, you can have the grown out conversation with your lead, and they'll say, okay, slip in a few 30s and you'll be fine.
Yeah,
I say in hope.
So Helen asked if anyone has any update on what RPs need to produce in the key information document.
That is a very good question, because, you know, I've been talking to RPs about doing it. Small RPs getting underway on that now, but actually in the output, it's saying that Homes England and the government are actually going to do some stuff for us. So I think we need to see what comes out there, but no doubt we'll have to turn it into speak that our consumers will get. But in theory, that part of that work is being done for us, and including the work we need to do in terms of the sustainability assessment as well. So the outputs we're kicking out, or our financial brokers, advisors are kicking out to on that sustainability calculator, and that's likely to change as well.
Jonathan, anything to add there on how you're advising people to change their key information documents?
I'm afraid not. It's very much as we're still waiting for the stuff to come out. I think it's just another flag that will need to be picked up. And then it's also, Jeanette made a very good comment earlier in relation to advertising stuff. It's also, what are these policies going to be and how are you going to advertise them? So you've got to be careful of misrep and other parts and inadvertent catches that may come through that, especially with the power of Twitter to override certain documents if someone said something.
Okay, that's great. So just a couple more here, one from Yezgani. How is the RCGF going to look like? Does anyone know?
I'm not going to be able to comment on that one, I'm afraid, at this time.
Okay, that's fine. That's fine. Next, sorry, Yezgani, we will come back to you on that in one of our future webinars. And one left here, and then we are all free. Caroline, NLG and NSG are going to link in together to agree a helpful document. Does that?
Sorry, I missed part of that.
There's a lot of abbreviations there. I'm not sure. NLG and NSG.
That's the national sales group. It will be. Oh, yeah. They'll link together to develop a suite of literature that we can use across the sector.
Yeah, that'd be useful.
Okay, great. Very helpful. Thank you, Caroline. Right, this has been a pretty big involved conversation. We've delved into lots of different areas. I really want to thank Jeanette Grady. Having the group head of sales for Taurus really helped this discussion, as did having you know, one of Devonshire's finest, Jonathan Corris. So thank you to both of our guests today, and of course our resident experts, Greg and Andrew. So we're going to hopefully do a follow-up on this when details do change and we do know more, so please do look out for that. You're all going to be sent the slides. There's some handouts here as well if you'd like to discuss how SDS can support your appraisal process, your home ownership, all the shares that we talked about. We do have a piece of software that does this and updates it straight to SQL. So we are pretty much in the right place to support you and to give you a great all-in-one system. If you'd like to explore that any further, then myself and my good colleague Ricky Prota, we're always trying to talk to you, and we will continue to try and talk to you about these things and make sure you know who we are and how we can help you. I would like to wish everyone a great rest of week. Thank you once again to all of our panelists. Andrew, before I wrap up, have I missed something there?
No, just one thing for next week. We're doing a bit of a webinar with Safa Cooper about IMS. So,
yes.
So, and the changes and what's required on the updated version on IMS. So I know that they're all waiting for some updates on the shared ownership, which I believe is in there now, I think. But they are going to talk through that and the impact on what needs to be inputted. So that'd be quite interesting. If you're...
And that's going to be Sean Stafford and Sue Misson. They're both industry professionals, very respected. We absolutely love having them on. That's going to be a really great one. So please look out for that. The e-shot's going to be with you, or just drop us an email and we'll make sure you get invited.
Brilliant.
So once again, thank you everyone very much. And we hope to bring you more of these webinars.
Very soon.
Thank you. Bye.
Guys.
Thanks again. Bye, everyone.
Bye.
Thank you.
Thank you.